Get your money out now. I'm your host, Steve Van Metre, and thanks for joining me today. With banks leading off third quarter earnings, we're starting to get a glimpse of why the banks will soon start freezing credit cards and other accounts. Let's head over to CNBC where we can figure out what's really going on with the banks. JP Chase tops analyst estimates for third quarter profit on gains from interest income. Perhaps the good news, but the bad news yet to come, as the biggest U.S. bank by assets said profit fell 17% from a year earlier to $9.74 billion. Third quarter revenue jumped 10% to $33.5 billion thanks to higher interest rates as the Fed battles inflation. Early signs of those headwinds begin appearing in the quarter as JP Morgan booked $959 million in losses on securities in the quarter, reflecting the broad declines in financial assets in the quarter, sapping earnings by 24 cents per share. So here you can see even the big banks aren't immune to declines in the stock market and the bond market, and here you can see JP Morgan taking losses. But they also note in their comments of their earnings that they need to be careful about the impact of quantitative tightening on deposits and deposit migration. Now, what are they talking about here is that quantitative easing incentivizes banks to create deposits. Now, they don't create them out of thin air. They just kind of force investors or savers to hold their money in cash. And so that's what the banks do. They create bank deposits with customer cash. Now the QT is here. That money is leaving. What are the banks worried about? You see JP Morgan talking about deposit migration. Well, where is that money going to magically go? Well, it's going to go to money markets. And who's the biggest backstop of that right now? Well, that's the Fed. And so that's what they're concerned about. But I want you to understand this is exactly what the Fed wants to happen with QT. They want these deposits to leave the banks. They want the banks then to raise interest rates on deposits and then pull that money back. JP Morgan seems to be concerned about it. But that's not the only thing. They know that the shape of the yield curve is an issue and economic reasons to take investment security losses. So perhaps what you see here is the bank is saying, look, we're just going to take losses on these securities because that may be more prudent than holding them. Because if you look at the history of the yield curve, which we talk about a lot on the show, when it's inverted, and in this case deeply inverted, what does it tell us is likely to come? Well, it means stocks are likely to head much lower as we head in recession, and interest rates are going to head down, and that means bond prices go up. But JP Morgan isn't the only bank with some bad news. Now let's turn to Wells. Wells Fargo said profit falls as bank boosts loan loss reserves. Those key three words are going to show up more and more in the future as shares rise. Wells Fargo said Friday is still seeing historically low loan delinquencies, but a decision to build up reserves as the economy slows cut into its third quarter profits. So what is Wells talking about with these loan loss reserves? What does this mean? Well, remember, banks lend out other people's money. They're depositors. And if those loans go bad, the bank is on the hook to take the loss. So when they start to get a feeling that things are getting bad or going to get worse, what they'll do is they'll start building up their loan loss reserves, meaning if those loans go bust, that means the bank has to step in with their money and make the depositor whole. And that's what you're seeing here, and that's not a good sign about the future economy. The provision included a $385 million increase in the allowance for credit losses, reflecting loan growth and less favorable economic environment, the bank said. As the most mortgage dependent of the six big U.S. banks, Wells had faced pressure as sales and refinance activity has fallen steeply as the average rate for 30-year mortgages climbed to a 20-year high near 7%. And again, this is what we've been warning about, is that profits for the banks are going to head lower as interest rates go higher and demand for credit falls. And so what you're hearing from Wells saying is, look, we think the economy is deteriorating and we're building our loan loss reserves. Now you have to remember, when the economy is booming, banks are eager to lend money out because they're making so much money. They know a certain percentage of them are going to lead to default. They know that. But when the economy slows and they have a ton of data on your bank accounts and mine to know what's going on in the whole world, they start to get more concerned about getting their money back. And that's why they start freezing credit lines and credit cards at a time when businesses and consumers need more credit to stay afloat. They find out that they're actually actually maxed out. And do the banks really think things are getting worse? Oh, they do. Let's see what Jamie Dimon had to say in a recent interview. Jamie Dimon's gut tells him the Fed will have to hike rates over the expected range of 4 to 4.5% to cool inflation, although I'll disagree. But it takes a while for the effects to be felt and the risk that the central bank raises rates to the point where the economy slows down and even tilts into a recession as demand contracts. Dimon says he doesn't foresee a rosy outlook on the U.S. economy, hence we see that in their bank earnings. On Monday, he told CNBC the U.S. economy is likely to face a recession in the next 6 to 9 months. He reiterated this view yesterday. I don't know if it could be a soft landing. I don't think so, but it might. In a tough recession, you could expect the market to go down another 20 to 30%. But if Dimon's right and we do face another tough recession, one thing that shouldn't drop another 20 or 30% is your portfolio. I'll put a link up here to Portfolio Shield and in the description below. Because even though Dimon thinks the Fed's going to get to 4 to 4.5%, I'll go and say I think the next hike in November is the last one. And why is that? Well, we're seeing signs the economy is slowing. Consumer spending was flat in September and well below expectations as inflation takes toll. Retail and food services sales were little changed for the month after rising 0.4% in August, according to the advanced estimate on retail sales. Excluding autos, retail sales rose 0.1% against an estimate of no change. And considering that retail sales numbers are not adjusted for inflation, the report shows that real, which is inflation adjusted, spending across a range of sectors the report covers retreated for the month. And in a very nice way, what CNBC's article is saying is retail sales decline. And we know that this is terrible news because what's going on, we talked about this the other day in the show, in terms of imports, in terms of inventories, they're ballooning. And now we're seeing exactly what we've been talking about is going to happen, that consumers are rejecting higher prices. They can't afford it. And in a polite way, that means inflation-adjusted retail sales are going down. While the gains for the month were muted, retail sales rose 8.2% from a year ago, matching the rise in the consumer price index. Notably, though, retail sales on a year-over-year basis did slow. Shoppers remain generally flush with cash, though there are indications of late they're dipping into savings to make ends meet. And again, this is something the banks know and the banks are watching. They're seeing people dip into their cash. They're seeing them take on all this debt. That's, again, why we will eventually start to see banks freezing credit lines, because they know, hey, wait a minute, you're touching your savings, and at your rate, you're going to be out of money. No way are we going to keep extending you credit. But what is the direction for retail sales? And that's what really matters for the economy. Well, is this just a dip that's going to turn around, or is this now a trend? Well, unfortunately, it's likely a trend. Here we can see in this chart advanced retail sales in blue. Notably, if you're wondering why it says advanced, it's simply because retail sales are heavily revised, and this is always just considered an advanced picture from the government. Against the Wilshire 5000, the total U.S. stock market, both on a year-over-year rate of change. And what do we note? Downturns in the stock market, and we've talked about this before on the show. What do they lead? They lead retail sales lower. As stock prices head down, look for consumers to cut their spending. And in a separate report on Thursday, it showed that import prices fell 1.2% in September, slightly more than the 1.1 estimates, while exports declined 0.8%. Now, again, this is key here because we're talking about not exports and imports, we're talking about the price of them. So now when we talk about inflation, what should we expect to see? Import prices rising, export prices rising, and what are we actually seeing is them both heading down, and that does not bode well for the future picture of inflation. And this is exactly why I think November is kind of the last hike the Fed gets through, because the economy is, somebody's going to show up in the data between November's meeting and the Fed's meeting in December, because what we're likely to see is a CPI start to come down. We'll talk in a moment again why it's not yet, but let's take a look at why import prices matter far more than most realize. Here you can see import prices in blue on a year-over-year rate of change. And I wanted to see, just before we go to the next slide, is that they're heading lower. That tends to happen into economic slowdowns. That's very normal. Now let's overlay the consumer price index, because we've talked about how U.S. consumer prices are highly correlated to gasoline prices. Well, the other big factor is import prices. Now look at this with import prices in blue, the consumer price index in red. You can see import prices heading down, and it tells us that the red line, or consumer prices on a year-over-year rate of change, is going to head lower at a time the Fed is tightening, and that puts the Fed on the wrong side of the path. Now let's take a look at this next slide. We see now the percent change, the monthly change in import prices, and we note that frequently that import prices either fall into a recession, lead that into recession, or an economic slowdown, as we saw it around 2015, 2016, and here we have it again. But what's keeping the CPI high? Well, to that we turn to our chief strategist, Jeff Snyder, who writes in his daily to subscribers to Markets Insider Pro. You can check that out at marketsinsiderpro.com. Link in description. He says these estimates all but guarantee another hike in November 2nd. What shocked markets today initially was the accelerating core rate, which is excluding food and energy. Most of the increase in prices of late are actually due to last year's housing imbalance, delayed statistical reaction in the form of owner's equivalent rent. When energy subtracting almost as much as the OER contributed, the rest of goods prices have decelerated to the point, as we keep hearing anecdotally, from inventory overloaded companies. He notes that the current version is predicated on what that part of the CPI is indicating, meaning this year's recession, while the rate hikes are based more exclusively on last year's home price bubble. So what he's suggesting is exactly what we've been saying, is inflation is going to come down. So now you know why the banks are going to start tightening and going to start freezing accounts, because they see the economy slowing down, and what they care about is getting their money back. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.